There are 5 bills sitting in your mailbox right now that you are legally allowed to stop paying. 5. And if you are 65 or older, at least one of them almost certainly has your name on it. Here's what this video is actually about. I am going to walk you through 5 specific bills that millions of American seniors are still paying every single month, not because they have to, but because nobody ever told them they could stop. And before you say, "That's probably not for me," I need to stop you right there, because that assumption is exactly what costs people thousands of dollars a year. Most people hear a video like this and they immediately sort themselves out. Either they think it is only for low-income seniors who are really struggling, or they think it is some fancy wealth management trick that does not apply to someone living mostly on Social Security. Both of those are wrong. Dead wrong. This list is for both of you. Whether your entire monthly income is one Social Security check, or you have a pension, some savings, and a home that has tripled in value since you bought it, there is real money on this list with your name on it. I will tell you on every single one exactly which group it helps most and how. So no one watching this can look at their screen and say, "This is not for me." So here's what we are going to do. 5 bills, one at a time, in plain English. And then I am going to give you 3 bonus moves at the end specifically for the retiree who has built up some money, because those last 3 can be worth a fortune and almost no one talks about them. Stay to the end. The very last one is the one that quietly costs people the most money, and it is one of the easiest of all to fix. But first, I need you to understand the one idea that ties all of this together. Being legally exempt from a bill and actually not paying it are 2 completely different things. The law does not refund you automatically. Nobody mails you a check. You have to know the rule exists and you have to claim it. That is the entire reason this video exists. And the reason almost no one tells you about these exemptions is brutally simple. Every single person whose job it is to collect money from you has a direct financial incentive to keep their mouth shut. Your county does not call to tell you they will freeze your property taxes. The Social Security Administration does not remind you that you can stop the withholding coming out of your check. The tax preparer charging you $300 does not lead with the fact that you may legally qualify to have your return done for free. They are not going to tell you. So let us start. Bill number 1 is your federal income tax. I need you to really hear this, because for millions of seniors, the correct amount of federal income tax you owe going forward is far lower than what you are currently paying. And for a great many of you, it is 0. Yet millions of seniors are still paying it, or still having it withheld out of pure habit and fear. Here is what changed. There is a new law, the one you have heard called the One Big Beautiful Bill. And buried inside it is something I want you to remember by name. Call it the Senior Bonus Deduction. Starting with the 2025 tax year, the one you file in early 2026, every single person who is 65 or older gets an extra deduction of up to $6,000. If you are married and both of you are 65 or older, that is $12,000. But here's the part that makes it so powerful. That $6,000 stacks on top of everything you already get. It sits on top of your regular standard deduction. It sits on top of the extra standard deduction seniors have always received for being over 65. You do not have to itemize to claim it. You do not have to give anything up to get it. It is simply added on. Now here's who this helps, and I mean this when I say it covers both groups. If you are a lower income senior living mostly on Social Security, stacking these deductions very likely pushes your federal income tax all the way to 0. It may even mean you do not need to file at all. And if you are a comfortable middle-class retiree, you are not left out either. This deduction is available in full to single seniors earning up to $75,000 a year. For married couples, that ceiling is $150,000. It only begins to shrink above those numbers and does not fully disappear until you are well above that range. So the only people this truly leaves out are the genuinely wealthy. Everyone from the retiree on a modest fixed income to the couple living comfortably on $90,000 a year gets real money here, but I need you to hear this part clearly, because it makes this urgent. This is temporary. As the law stands today, the senior bonus deduction is only here for 2025, 2026, 2027, and 2028. 4 years, unless Congress extends it. This is a claim it now, every single year while it exists situation. If you use tax software, it will ask your age and apply it automatically. If someone prepares your return, you make sure they applied it. If they did not mention it, ask them directly. That is bill number 1. And it is the single most valuable point in this entire video. Do not pay federal income tax you do not owe. But that leads straight into bill number 2, because it is the other half of the same coin. Bill number 2 is the tax on your Social Security benefits. Now, a lot of people believe Social Security is always taxed. A lot of others believe it is never taxed. Both of those people are wrong. Here's the actual rule, and I am going to give it to you as simply as I possibly can. Whether your Social Security gets taxed depends on something called your provisional income. Think of it as your other income, plus half of your Social Security benefit added together. There is a lower line and an upper line. If you are single and that number comes in under $25,000, or married and it comes in under $32,000, then 0% of your Social Security is taxable. None of it. As your income climbs, more of the benefit can be taxed, up to a maximum of 85% for higher income retirees, which means even at the very top, 15% of your Social Security is always tax-free. So here is the win for each group. If you are a lower income senior, there is a very good chance the correct tax on your Social Security is 0. And the new senior bonus deduction we just talked about makes that even more likely. If you are a comfortable retiree with more income coming in, I am not going to insult you by pretending it all disappears, but that new deduction can still drop the taxable portion down to a lower tier and put real money back in your pocket. Here's the mistake that hits everyone, though. Rich or poor. When people first sign up for Social Security, a great many of them check a box on a form called the W-4V. That form tells the government to withhold federal tax from every single monthly check, just to be safe. Then a big chunk comes back as a refund the following year, if they even remember to file. Think about what that actually is. You are letting the government hold your money, with no interest, all year long, on tax you may not even owe, or far more than you owe. The fix is simple. You look at your real numbers, or you have someone look at them with you, and you file a new W-4V to right size or stop that withholding so it matches what you will actually owe. Not $1 more. Whether you owe nothing or owe a little, the goal is the same. Pay what you owe on time, and not 1 cent early as a free loan to the Treasury. That is bill number 2. Now, bill number 3 is the one that makes people genuinely angry once they find out, and it is your property tax. I want to be precise here because this is exactly where seniors at both ends of the income spectrum get told they do not qualify, when very often they absolutely do. Here is the truth. There are really 3 kinds of senior property tax relief, and between them they cover almost everyone. The first kind is income-based, often called a circuit breaker program. That one is aimed squarely at lower and fixed income seniors. If your income is modest, this can knock your property tax down dramatically. In some places, a low-income senior can have a massive share of their home's value exempted, or the tax deferred entirely until the home is sold. The second kind is a flat senior exemption that knocks a chunk of assessed value off the top, regardless of your income. The third kind is the one comfortable retirees always assume they are too well off for. It is an age-based freeze, with no income test whatsoever. Let me give you the clearest example. In Texas, once you turn 65, you get something called a tax ceiling. It freezes your school property taxes at the level you paid the year you turned 65. Your home value can double. Your frozen tax does not go up. And there is no income limit on that freeze. It does not matter how comfortable you are. You qualify because of your age? Period. Texas is far from the only state with a freeze like that. So look at how this covers both groups. The lower income senior gets the income-based relief that can wipe out most of the bill. The comfortable senior who assumed the income-based program was not for them still gets the age-based exemption or freeze that they never even applied for. Here is the catch that costs everyone. None of these are automatic. Your county does not look at your birthday, see that you turned 65, and apply the discount. You have to file. And almost every one of these programs has a hard deadline, often early in the year. Miss it, and you pay the full bill that year and wait until next year to try again. Why would your county not chase you down to claim it? Because every dollar of relief you claim is a dollar of revenue they lose. They have no incentive to find you, so you make one phone call, call your county assessor's office, or search your county name plus the words senior exemption and freeze, and you ask 2 questions. What relief do you have for homeowners over 65? And which programs are based on age with no income limit? That one phone call has been worth hundreds, often thousands of dollars a year, to people I have worked with directly. Make the call. That is bill number 3. But here's the thing. You could be getting all 3 of those wins and still be overpaying on bill number 4, because this one is almost completely invisible. Bill number 4 is your utility bills. Most seniors have never heard of the Low Income Home Energy Assistance Program, or LIHEAP, and the word low income in the name is exactly why they tune out. That is a mistake. LIHEAP is a federal program that helps eligible households pay for heating and cooling costs. And while it is income-based, the income limits are higher than most people assume. In many states, a household earning up to 60% of the state's median income qualifies. Depending on where you live, that can mean a household income well above what most people would call low income. But LIHEAP is just the beginning. Most major utility companies, gas, electric, and water, are required by their state regulators to offer what are called lifeline rates or senior discount programs. These are reduced rate structures specifically for customers who are 65 and older or who meet certain income thresholds. Some of these programs cut monthly utility bills by 20 to 30%. Here's the part that should make you put down whatever you're doing right now. These discounts are almost never applied automatically. You have to call your utility company and ask if they have a senior rate, a lifeline rate, or an assistance program for customers over 65. That is it. One call. And if you qualify, they apply it going forward. They do not go back and refund you for the years you overpaid. There is also a separate program called the Weatherization Assistance Program, which can pay for insulation, sealing, and efficiency upgrades to your home that permanently reduce your energy bills. Not a loan, not a rebate. They send a crew to your house and do the work. And on top of all of that, many states have their own separate utility assistance programs that stack on top of the federal ones. The point is this. Your utility bill is not a fixed number. It is a negotiation you never knew you were allowed to have. Call your gas company. Call your electric company. Ask about senior rates, lifeline rates, and assistance programs. Do it this week. That is bill number 4. Now, if you are still watching, I want to say something before we get to bill number 5. The people who find this information and actually act on it are the ones who win, not the people who nod along and forget about it by tomorrow. If this is hitting home for you, if you are realizing there is money sitting on the table that you never knew about, I want you to do one thing right now. Hit that subscribe button, because I put out videos specifically designed to help people in or near retirement keep more of what they have already earned. No jargon, no products to sell you, just the information that the people collecting your money do not want you to have. And drop a comment below. Tell me which of these bills surprised you the most. I read every single one, and your comment helps more people find this video. Now, bill number 5. This one is the one that quietly costs people the most money, and it is one of the easiest to fix. Bill number 5 is your tax preparation fees. Every year, millions of seniors hand over $100, $200, $300 or more to have their taxes prepared, and millions of those same seniors qualify to have that return done completely free of charge. The program is called VITA, which stands for Volunteer Income Tax Assistance, and there is a second one called TCE, Tax Counseling for the Elderly, which is specifically designed for people 60 and older. These are IRS certified programs. The people preparing your return are trained and certified by the IRS itself. This is not a shady pop-up service. This is a legitimate, high-quality program that has been running for decades. Who qualifies? VITA generally serves people earning $67,000 a year or less. TCE has no strict income limit for basic returns and is specifically focused on seniors. Here is what they can handle. Social Security income, pension and retirement income, investment income at basic levels, the new senior bonus deduction we talked about earlier, all of it. And here's the part that should make you genuinely frustrated if you have been paying for this. The IRS also has a program called Free File, which lets anyone earning under $73,000 a year file their federal return using commercial software, completely free. Not a trial, not a discount, free. So if you are paying a tax preparer and your income is under those thresholds, you may have been paying for something you were legally entitled to get at no cost. To find a VITA or TCE site near you, you go to irs.gov and search VITA or TCE, or you call 211, which is a free community resource hotline available in most areas. That is bill number 5. Now let us talk about the 3 bonus moves, because I promised them and I do not want to shortchange you. These are specifically for the retiree who has been responsible, built up some money, and has assets to manage. These are the ones that can be worth the most and the ones that almost nobody talks about. Bonus move number 1 is the Qualified Charitable Distribution, or QCD. If you are 70 and a half or older and you have a traditional IRA, this one is extraordinary. Here is how it works. Normally, when you take money out of your traditional IRA, it counts as taxable income. Every dollar you pull out gets added to your income for the year. That can push more of your Social Security into the taxable zone. It can affect your Medicare premiums. It can bump you into a higher bracket. But there is a way to give money from your IRA directly to a qualified charity and have it count towards your required minimum distribution without that money ever touching your taxable income. You can give up to $100,000 per year this way. The money goes directly from your IRA to the charity. It never hits your adjusted gross income. Why does that matter so much? Because it is not just a deduction. A deduction reduces your income after the fact. This move means the money never shows up as income in the first place. That is a completely different and far more powerful outcome. If you are charitably inclined and you have an IRA, you need to be talking to your financial advisor or tax professional about this right now. It is one of the cleanest tax moves available to retirees and one of the least used. Bonus move number 2 is Roth conversion strategy. Now, I know some of you just tensed up because Roth conversions sound complicated. They are not. Here's the simple version. If you have money sitting in a traditional IRA or a 401k, Every dollar in there is going to be taxed when you pull it out. And starting at age 73, you are required to pull money out every year whether you need it or not. Those are called required minimum distributions, or RMDs. The problem is that if you have a large balance, those forced withdrawals can push you into a higher tax bracket, increase the tax on your Social Security, and even raise your Medicare premiums. A Roth conversion means you move some of that money over to a Roth IRA now, pay the tax on it at today's rate, and then all future growth and all future withdrawals from the Roth are completely tax-free. Here is when this makes the most sense for a retiree. If you are in the early years of retirement before your RMDs kick in, and your income is temporarily lower than it will be later, you may be sitting in a lower tax bracket right now than you will be in 5 years. Converting some of your traditional IRA to a Roth now, at a lower rate, can save you a significant amount over time. This is not for everyone. It depends on your specific numbers. But if you have a large IRA balance and you have not had this conversation with a tax professional, you are potentially leaving a significant amount of money on the table. Bonus move number 3 is strategic timing of income. This one sounds simple because it is, but the implications are enormous. Every year, your tax situation is determined by how much income shows up on your return. And for retirees who have some control over when they take distributions, sell investments, or receive certain payments, that timing is a lever you can actually pull. Here's a concrete example. Let us say you are in a year where your income is lower than usual. Maybe you had a medical expense that reduced your taxable income. Maybe you deferred some income into next year. That lower income year might be a great time to do a Roth conversion, sell an appreciated investment at a lower capital gains rate, or take a larger IRA distribution while you are in a lower bracket. Conversely, if you know next year is going to be a high income year, maybe you are selling a piece of property, you want to be careful about piling on additional income in that same year. The point is that income is not always something that just happens to you. For retirees, it is often something you can shape. And shaping it intentionally, with a clear picture of your tax situation, is one of the highest value things a retiree can do. This is exactly the kind of planning that gets skipped when you are rushing through a 30-minute appointment with a tax preparer in February. It requires looking ahead, not just looking back. All right, let us bring this all the way home. Here's what we covered today. Bill number 1, federal income tax. The new senior bonus deduction gives you up to $6,000 extra, stacked on top of everything you already get. Available now through 2028. If you are not claiming it, you are overpaying. Bill number 2, the tax on your Social Security. You may owe far less than you think, and you may be giving the government an interest-free loan every month through unnecessary withholding. File a new W-4V and right-size it. Bill number 3, your property tax. Age-based freezes and exemptions exist in most states with no income test. One phone call to your county assessor could save you hundreds or thousands every year. Make the call. Bill number 4, your utility bills. Senior rates, lifeline programs, LIHEAP, and weatherization assistance exist in almost every state. Your utility company will not tell you unless you ask. Ask. Bill number 5, your tax preparation fees. VITA and TCE are free, IRS certified, and specifically designed for seniors. If you are paying for tax prep and your income is under the threshold, stop. And the 3 bonus moves. The qualified charitable distribution for IRA holders who give to charity. Roth conversion strategy for those with large traditional retirement accounts, and strategic income timing to keep yourself in the lowest possible bracket every year. Here's the thing I want to leave you with. Every single one of these wins was already available to you before you watched this video. The law already had your name on it. The programs were already funded. The exemptions were already in place. The only thing standing between you and this money was knowing it existed. Now you know. The next step is simple. Pick the one that resonates most with your situation right now and take one action this week. One phone call, one form, one conversation with a tax professional. Because the difference between knowing this and doing this is the difference between money staying in your account and money quietly leaving it forever.